All right. Great. So we're looking at the future for El Salvador, and now we're going to be looking at the future for Bitcoin globally, speaking about credit specifically. Obviously, we are currently in a fiat system, political currency system, that's dependent on perpetual credit, indefinite credit. And this is one of the big questions I get, that I hear it's often asked, is will we need credit on a Bitcoin system, on a hyper-Bitcoinized world? And so we're going to have a panel here discussing that very question. So here are our wonderful guests. Come on up, guys. Yeah. Give them a hand.
All right. I think we just decided I'm moderating this.
Feel free.
This is a bigger crowd. It's late in the day. I'm pretty excited about this. Who thinks we're not going to have credit on a Bitcoin standard? Raise your hand. Okay, we got a few. Yeah.
Sorry, just this is a good moment for a disclaimer. I'm not entirely anti-credit, but for my love of symmetry, since Hubertus is going to play the credit guy and you are kind of the moderator, I will be severely anti-credit, so you have to raise my hand.
So there we go. I mean, how do you guys want to start this?
Well, what I propose, Eric, is that we just start with common ground first. So
Yeah.
try to find the common ground between those who just raise their hands that they don't believe in credit in a Bitcoin system for whatever reason. And Giacomo.
Yeah, maybe we start there then.
And those who do. Because I think what we probably have in common, Mr. Anti-Credit, Giacomo, is I guess we all believe that Bitcoin is the medium of exchange, which will be the medium of exchange, we want to make the medium of exchange. We probably all want a Bitcoin money stock, which is no more than 21 million. We want it fixed. Yeah? And last but not least, we think it only needs one chain, the Bitcoin chain. The question is that okay for the non-credit side of the debate?
I think there may be some debate on the last part. Of course, we want one chain, which is the source of the truth for the settlement layer, but probably even for scalability consideration, most Bitcoiners think there will be some kind of second layer sharing of a single coin. So even if we have one chain for settlement, one single coin will probably be owned by different people in different ways. One way could be trust minimized, like a lightning channel, where there is a natural enforcement mechanism, and some way could be Alfini style, in which this coin is actually controlled by one key, but is legally or reputationally shared among the different amount of people. So maybe I'm not so absolutist about the one chain thing. There will be some different layers, but I agree. The supply will be limited, must be limited, otherwise not Bitcoin. And we want Bitcoin to be not just a good store of value, but also eventually a medium of exchange. So these two premises are good.
Okay. Mr. Margera?
Yeah, so I think it's good to like baseline on this too. I think that there's two sides to the idea of we will not have credit. One is that from a macroeconomic standpoint, there's going to be this deflationary new tech boom that's going to emerge. If you think like Jeff Booth's price of tomorrow type logic, and that's going to be this like top-down view of like, here are the fundamental incentives that are going to drive credit out of the market, and people are going to naturally start to choose it. And then the other that Giacomo is just presenting is that, in fact, we might have protocols that are built on top of Bitcoin that are going to be so efficient in the way they operate, they could also push node issuance fundamentally out of the market. And then we're going to have these shared type systems of control. And while serving similar functions, technologically, it's going to be fundamentally different. And we go back and we think about like how banking systems originated. You could think about banks as like a scaling mechanism for commodity-based monies in a lot of ways. But I'll leave it at that and then pass it over to you.
Yeah, that in fact is the case. And maybe before going into that, what we also have to keep in mind that today many people think about credit, which is something which you get from a bank. You go to the bank, they give you credit, you get money, but that's not what it used to be. Credit used to be something you had. You had morals, you had honor, you fulfilled on your contracts. That means you had credit. You were a person trustworthy to engage with in business.
Like a reputation index, in a way.
Absolutely. That's the original word of credit, and without credit, you couldn't get a loan. So, but we're going to use it today in the sense which you just said, yeah, with this additional layer, which is on top of Bitcoin stock money. And the difficulty here, which I want to introduce into the debate right now, is that something which has been forgotten ever since we had fiat is the fact that even the gold standard money distinguished between credit proper and something in the middle which is forgotten, which is credit money, which is very important from, let's say, Austrian economists always have said that if you want a non-fractional reserves, a full reserve banking system, that adds a complication which very few people know about and which actually ruffles a few feathers, because in Bitcoin we're used to think about money, stock money, and there's almost nobody anymore who remembers credit money, because in the fiat system, the government has perverted it all. Once you do fiat money and you do credit money on fiat money, it's pretty much the same. So we are used to being robbed, inflated through credit money on fiat money, whereas when we had the gold standard and credit money to serve the needs of the industry and the logistics and production, the free banking system actually kept the value of gold currency stable over many, many hundred years without a problem, obviously before government came in.
One thing I'll quickly add to that, in the point that he's making is that under a free banking system where banks, before we had government and political capture that infringed upon this system and started to influence the incentives of it, free banks had this natural amount of like fractional reserve credit that would emerge, but it finds a market equilibrium. So there's an inflationary process when the system emerges, but once it finds a market equilibrium, it's not a long-term sustainable form of inflation. Credit ebbs and flows within a range over time.
Yeah, did you first want to say something before I respond to the fractional reserve? Because that's
Yeah, no, it's not exactly what you're talking about.
Yeah.
But I would have like a more fundamental challenge to that is that you are basically depicting an equilibrium that we had in the past where credit money exists, is used, and is not perverted by the government. But I think that one point that many Bitcoiners will make is that credit money has been perverted by government, especially because it was easy to pervert intrinsically. One thing you said before is that even credit money requires some level of reputational ranking, some level of web of trust, let's say. Could be decentralized in many ways, but anyway, trust is inherently connected to your identity in some degree. Being connected to your identity means that the government, when it's bigger and has more guns, can come to you because they know who you are, where you live, and take it from you. The cypherpunk idea, which together with Austrian economics, I always see Bitcoin as some kind of merge between cypherpunks and Austrians. The cypherpunk idea is, even if the government is bigger with more guns, it cannot hurt me if it doesn't know where I live, where I am, at least to some degree. So I can use obscurity of information about me as a weapon against the bigger guy, as a resymmetrization tool. So if we go, so credit money is intrinsically weaker in this regard. So my point would be that the reason that the government corrupted it is that it's easy to corrupt. So Bitcoiners will want to at least minimize the use of the tool if possible.
Yeah, there's nothing to be said against it. Actually, I agree fully with that. The point is, now that we have the cryptographic technology to make things verifiable along the path of credit money, which was unknown before. Yeah? We have now the technical tools to trace the beginning of a bill of exchange. That's the standard private money creation instrument for the last 500 years, even before there was government money. So we are able to trace this bill of exchange even from before it starts, because we have the possibility as technologists to put the actual invoice of the goods which were paid into the money creation. In fact, one protocol which we are developing does that. So if you pay something with bill of exchange, you have to put the original invoice so that anybody who accepts that can check this is a real bill. Yeah, this is the so-called real bill doctrine, which the economists here may have heard of. So, and along this stage, as it passes peer-to-peer, from person to person, one person pays that person, Eric pays you, but everybody forms a guarantee chain and has personal responsibility. And I think there are a couple of rules from, I would say, different from the privacy orientation of the cypherpunks, which I think are more the 3 Fs, yeah? A free market, yeah, financial sovereignty, yeah, and so to say the freedom to choose your own money. And once you have that, you can choose whether you accept my bill of exchange or not, and you have to give me the credit that I'm good for engagement, that I will pay you back. And if you Giacomo, accept Eric's, you essentially judging him, even if you don't know me so well. I mean, Austria is far away from you, but you rely on him to hold you good if Hubertus doesn't pay. So this chain, the longer it gets, the more safer this private money is, whereas bank money today in the fiat system is completely unsafe. When we had the bank runs recently, the banks which were bailed out by government were not banks which were huge. These were below top 10 banks, but they deemed them systemically relevant, so they had to be saved and bailed out. So this is a crazy situation. We have a crazy, fragile house of cards in banking because of fractional reserve. So we definitely, when we talk about credit, we need to talk about fractional reserve because it should never, ever happen again.
Yeah, so I'll expand upon that and bring it back to you, I think. Once again, to kind of like summarize some of it, there's a distinction in credit issuance between whether or not it has to come from a fractional reserve banking system or whether it naturally emerges in other areas of the economy. Credit serves this function, to the point he was making earlier, credit is the oldest form of money. Before we had commodity-based monies, credit is simply trust. It's some form of deferred payment, and we have different ways of structuring it. The way that commodity-based monies allow us to bring value forward in time, credit allows us to bring money from the future to the present. So it serves a separate function, and we need it to support expectations that change throughout the economy. So when he's talking about this type of trade credit that emerges, there's ways that exist today, and maybe it'd be good to talk about how the bill of exchange has ultimately been replaced in the modern economy, and like working capital type structures and all that.
So I'll take the Giacomo. Did you also want to first?
Yeah, I will just take the chance for a very brief clarification of my previous point from the ideological point of view, because Hubertus mentioned basically free markets and freedom of markets. I think we have to make a distinction here. There is an ethical point about something being legit from a free market perspective, and then there is a strategical point about something being convenient or good or safe. For example, is it free market if everybody voluntarily agrees to give up guns to one specialized bodyguard so that you have more efficiency because division of labor? Yes. Is that prudent? Is that safe? No, because the guy could eventually took over. So a free market could have a free market outcome that itself will produce some denial of free market as a consequence. So for example, using closed source code should be something that you can decide to do, but we prefer, as a Bitcoin ethos, to say you're free to use closed source, but we want open source because it will defend us better. So we want decentralization of schooling, maybe we want homeschooling, we want home defense with our guns, because it's legit to do otherwise, but will bring to a bad outcome. So my point was not, mostly like in this debate, the free banking side has this name which I think is not very appropriate, because I think both sides want free banking, but one is making the point that everything which is ethically allowed it's also equally good. And the other is making a point, I mean, having something based on reputation is legit, is free. I don't want to deny this freedom, but I'm suggesting that we don't use this freedom if possible, because that will create the surface of attack by somebody knowing the identity. Just another quick point about technology. I'm very interested into elaborating further because, for example, I know that there were some experiments with Ripple, not the shitcoin, the original Ripple protocol coming before Bitcoin. That was a system to use public key technology to basically route automatically personal peer-to-peer credits. So I owe you something. You owe him something, so we can Ripple, we can route. That was a legit system. Satoshi himself said it was interesting. I never took off, maybe because of fundamental problems, because in this case, there is always a problem of knowing your counterparty. So you have to limit the anonymity of your counterparty.
Well, so those were a couple of points. I mean, first of all, I think the prediction, actually the requirement, is that if we have, and we will have, a Bitcoin credit system, it must be, of course, open source. Yeah, it must be transparent. Everybody has to see what's going on. And more than that, there has to be an agreement, a consensus on what rules will the system run. And there will be a debate about that, because there are rules then embedded in this code which make this good credit money, so that we don't get what government did to make credit money on bad credit, which is future goods instead of present goods. So that's the first point, open source. And when I talk about a free market, I'm sort of saying not talking as a complete anarchist now. Yeah? It's more like the complaint that money issuance has been taken away from private business without good reason about 150, 200 years ago. I mean, some free banking system have lasted into the last century, so they were around for 100 years and more. But I'm talking about free market in the sense that this business segment, which is very lucrative, has been essentially usurped by government and is controlled by central planners. It's a socialist central planner undertaking. And these guys make monetary policy, politics, on something which can be decided by the market. If you have a free banking system, businesses which need credit will go to BitCredit mints. For instance, if we take the BitCredit protocol, our proposed implementation, and we'll say, okay, I'm willing to pay a minting fee of, say, 2% for 3 months money. Do you mint? Do you take it or not? Or you mint? It's free code. Everybody can download it. Everybody can build a mint. And the mint can say, yeah, I'm going to do it for you, 2%, because I know you, or I charge you only 1.5%. So it's going to be a free market discount rate, which we haven't had in 150 years. And this discount rate, when it's set by one central institution, is one of the elements which causes booms and busts in most countries of the world. So that's what I mean in free market, and I agree fully. I'm a state minimalist. So against bigger, but there needs to be something. So yes, agreed with your point.
I think a key point is that the protocol rules will emerge by consensus, right? Like, we could talk about however these rules are set up, but the idea is fundamentally, how is this system's incentives going to be aligned? If we have a Bitcoin-based standard and we have, protocols like the Lightning Network, or we have things like Fedimints, and the Lightning Network, you wouldn't see any sort of expansion of the money supply, but with something like eCash on a Fedimint, there is potential that we could. And the question is, are the incentives aligned in order for that to ultimately happen? That's what all this boils down to. And I think that, to Giacomo's point earlier, when we look at what regulated free open banking systems in the past, you don't want to think about it from a top-down perspective at a systemic level. You want to think about it from the bottom up, the individual, very like Austrian take of how would the individual's incentives look in the system, and it's what would make a bank want to remain solvent, and will it be possible for them to do so if they were to pursue some sort of credit note issuance that ultimately led to like a fractional reserve. And that's something that, with the information transparency of the system that we're going to have, with web of trust type reputation-based systems, with the ease at which transactions can ultimately be conducted at such a low cost, and the ability to retain unilateral exit through shared custody type protocols, that's the type of system that's going to align incentives so that they're so efficient, so that we never see actual fractional reserve type credit ultimately emerge. But nonetheless, if we do have these note-based secondary markets for other forms of credit that you're discussing, I think the key question kind of boils down to, why would somebody accept that at the individual level instead of Bitcoin directly?
I mean, that's a very important question, and I guess what's a little bit underappreciated as we have been for 15 years, thinking a lot of what makes a good money and what's a shitcoin. What got a little bit forgotten is that a monetary system consists of both things. It consists of money and it consists of credit, and this in-between thing, which is called credit money. So when we talk about what you, Eric, don't seem completely like made up your mind about will there be fractional reserve banking which can artificially inflate, or will it be full reserve? And I think it's a question of consensus. there will be other people, there will be probably various protocols proposed which have different attitudes on that. On the BitCredit protocol, which I believe in, which can work, fractional reserve bank will not be accepted. We have today 44 trillion of central bank assets worldwide, which is about a third of global GDP, which means that the whole money which needs to be generated to, so to say, grease trade and industry as a medium of exchange essentially just needs 3 months of production worth to make sure that it's the right amount, because credit money is a dangerous thing. If you have too much, you get inflation and all kinds of troubles. If you have too little, then the industry, trade, production grinds to a halt. We've had that in Europe in 1465, in the Great Bullion Crisis, when we just had the stock of gold, no credit money. People couldn't find work, companies couldn't get their working capital, people starved, they lost their houses. So that's the one bad, that's the other bad side. So we must be walking a very narrow path, and that narrow path must be determined by businesses requiring credit money against real value, paying minting fees. And so I described this free market mechanism of discount rate, which has been out of use for 150 years. We haven't seen a real free market discount rate for 150 years. And BitCredit protocol will solve that. And once we have that money supply in order, all the other types of credit in the future will be based either on base money or on credit money, which in history, Lynn Alden recently in one of her podcasts said it was a leverage of about 1 to 20. But personally, I think that was already when government shenanigans were going on. So I think a proper ratio probably will be 1 to 10. So if there's 21 million Bitcoin, we'll probably have something like 210 million in credit money, and of course also in debt which somebody will pay after a certain time. That's very important to know. So all this credit money expands, and also it must reduce when it's fulfilled its purpose as a medium of exchange, which is completely different to how government does it. Because if the central bank buys government bonds by printing money, I mean, we all know that the government will nominally pay back those bonds, but in reality, they'll issue new bonds in a greater volume to do this payment back. So that's not real money, and we won't need that anymore. So arguing for a system with full reserve based on those types of monies only, and the consensus, once we work on that, will be not to accept anything else. It's going to be our free decision.
Let me try to add another evil bad cop point against credit to court on Bitcoin. Together with my previous point that credit is inherently more fragile because of the identity, there is the point that in a Bitcoin economy that creates, well, actually you, Eric, anticipated this point a little bit. It has been made in a very good way, I think, that by Alan Farrington in Bitcoin is Venice. If we imagine an economy where money is deflationary, then when you enter any kind of share deal, so I'm taking part of your profit and part of your losses, then I'm relatively safe. So some kind of share market, stock market can still go on. But when we move to a bond market in deflationary environment, basically my risk of going bankrupt as a creditor or suffer a bankruptcy become unbounded, because now the value of the money I'm giving you is going to increase, never decrease. So the opportunity cost to give you that money will be very huge, and probably very few enterprises could realistically compensate for this kind of opportunity cost, for this kind of risk. So in a deflationary economy, how crazy must I be to credit you some Satoshis unless I trust you because you are really inside the non-scalable, smaller trust circle?
Yeah. Now, this is actually a very important point, because this narrative is around, and some people came to that conclusion personally, I heard, but there are also some people in the space who talk about that in the podcasts, that it is as good as certain that a Bitcoin economy is going to be deflationary. I don't think that at all. Yeah? I think if we have the correct mechanism of money issuance, not like the central banks which inflate to rob us money, And not like in the old gold standard, which had a small flaw, which caused it to be slightly deflationary. But if we do it correct and incorruptible, we have a general purchasing power which will be absolutely flat. And what's going to happen as we grow richer is that people's incomes rises. You simply will get paid more money. Now that conflicted a little bit with this idea that we are used to think about the stock money, those 21 million, which have to be fixed to be a sound foundation for the economic system. I think Seyfedin once called it the tape measure, which must not be elongated. Yeah, so we need that to have a stable measurement, a stable unit of account. But as the economy grows, when we get AI, robots working for us, we have to work less. It shouldn't mean that there must be deflation. Because if the money supply, the credit money supply, grows sufficient to grease that trade, the price will be extremely stable. And so I have to quote Hayek here, who in his latest book, Alternative Currencies, which some of us may have read, because it's kind of the first time philosophically that the idea which we live today, Bitcoin, alternative currencies, came up again. So Hayek said it's absolutely impossible that you can have a constant quantity of money and at the same time a functioning economy, full employment and wealth. It's impossible. And actually, which is funny, because he only emphasized that once he talked about alternative currencies, because he thought about different types of competing currencies, some which are deflationary, some which will be inflationary, and some which will be stable. And his outcome was, you need to go for that one which is stable, and consumers will choose. Will choose the one which is flat. Why? Because of the problem which Giacomo just mentioned. If you have a deflationary currency, then those people who need money, businesses always need money, they need loans. It will be very hard for them to pay them back, and it's unfair on them. Just as it's unfair today on the savers, which have saved all their life, put money back, and then comes the government, prints money, devalues the old money, and they can buy less and less and less and less as they grow older and older.
How would you, sorry, Eric, step in whenever you want. How would you respond to the criticism that there is some circularity here? Because I say that I would be crazy to do credit under deflationary economy. But you say that there will not be a deflationary economy because credit money will create the necessary counteracted inflation. So this is basically circular. If there is credit, there is no deflation. But as long as there is deflation, there will not be credit. So we can enter a kind of spiral that will make that kind of scenario basically impossible to realize. Is that correct?
That's absolutely correct. So I think like Bitcoin had to find its first application. I mean, nobody started out paying with Bitcoin originally. It needed a, let's say, rather shady, problematic area of the economy, as we all know.
Recreational substances?
Yeah, I drink coffee. It needed this special use case to make it clear to people, oh, this can be a medium of exchange in one use case. And with credit money, it can also be a use case. We are currently in the project group, which is dispersed, thinking on where can this actually start? Where is this really, really useful? And so the conclusion is that most likely the first use cases whereby this can start, because it will take time, will be high inflation countries like Argentina, countries like Turkey, Egypt, Zimbabwe, which suffer from inflation and where the banking system simply doesn't work. For instance, I heard from a friend in Argentina that you couldn't get any credit in Argentina, which has inflation of 160%, unless you knew a politician, because then you could get a credit for 25% interest only, which is a steal. So those types of countries and the businesses which try to operate there and prosper, those will be a prime countries, because Argentina, for instance, used to be one of the richest countries of the world. So it will be kind of like a Wiederaufbau, like after the Second World War, where you can have an economy arise out of the ashes as soon as you have a working credit money system. I
will try to make a subordinate point. Even assuming we can have reliable credit on Bitcoin because of non-hyper-deflation. And even assuming we won't, because as you said, without that, we have this kind of economical choke points in which we don't have economy working anymore. Assuming I buy those points, why do we need some kind of strange new system on top when, for example, Eric mentioned Lightning before. Lightning is not credit, it's fully collateralized, but Lightning suffer of a lot of problems of liquidity, inbound liquidity, route liquidity. So one of the proposals that Christian Decker made during the Berlin Lightning conference back then was we could even imagine in the future to overcome liquidity problems, some kind of negative balance channel. So I trust Eric, I know Eric, so this doesn't scale. It must be among channels that basically trust each other. I can decide that I will allow my balance with Eric to even go to 0 or below 0, because it's still between us and other parties will not be affected. And this can basically be used to use trust at the margins, only when needed, to basically boost some routed liquidity or incoming liquidity, let's say, supply when needed. So do we really need an entire new like mint system, or do you think something as trivial as negative amount channels could already do the trick?
Yeah, I think that's a good point, because these are all peer-to-peer setups, right? And like the analog today is that we have private market contracts. You have a specific contract with a supplier in your business. You can extend them more credit on different terms over time. It's conceptually the same thing. So what he's arguing for is that this is going to emerge as a note system. And kind of going back to the point from earlier, I still don't understand why the expectation would be that. I think it's possible that the secondary markets could form around note issuance for it. I also think that credit could be just simply relegated to these peer-to-peer type contractual relationships.
First of all, I guess Giacomo, you may be aware of that, just maybe you haven't mentioned it, but once you grant Eric the possibility to overdraw, you are granting him credit. So,
yeah, absolutely. That will become a credit. Lightning is not credit now,
yeah.
but this will become a credit system.
Yeah.
Absolutely.
Yeah. So I guess the answer here is this is still credit, but you are now experimenting with some new forms which are unexplored, which are just between the two of you guys. So you guys have to watch each other very well. The really 500 years of experience with the bill of exchange system has the advantage that it's codified after 400 years of experience in a law which is, so to say, it's been once called the most beautiful law in the world, the bill of exchange law. I don't know why lawyers can get so excited, but I guess that's the life as a lawyer.
Aesthetic is subjective, but I can imagine better laws. But okay.
The beauty of law.
Yeah. So this has 400 years of experience of private credit and what can go wrong and what happens in this case. So it's kind of good to build on the shoulders of this rich heritage of knowledge to just adapt it for what we can do now with cryptography in verifying every single step along the way, and have something which is worldwide recognized. One of the problems which we have is that lots of the things which we are doing is happening in a regulatory uncertain way. Now the beauty of the Bill of Exchange is 200 countries in the world have signed the 1930, don't laugh, 1930 Bill of Exchange Convention, so you can legally do that in any country of the world, and the state must, so to say, allow it to you. So that's one of the really nice things about that.
I agree that drawing on history, understanding what has already been built, the success of these systems, the risks of these systems, that's valuable. We can also draw on, a millennia of history with gold, and we're also pushing that out of the market too. And I think that that's a good example of how these technological efficiencies are fundamentally changing the way these relationships can emerge. But I think that a lot of this question boils down to if there being a secondary system to trade these notes when, Giacomo and I have this channel between one another, and for some reason I can write up a contract and say, I'm actually going to sell this credit that, I owe to him to somebody else, and he's going to allow me to do that. why somebody else is going to demand that issuance and whether or not they're going to trust that we can also ultimately settle that credit relationship in a way that's going to be, you know, economically accretive to them over time. And I think that, like, it all boils down to the fact that if that type of a system generates a fundamental economic yield, if that's creating more trade and more specialization and more wealth, then it will create incentives that will ultimately drive demand for it over time. I just don't, at the unit level, I don't see exactly what that could be yet or why.
I think let's not. I don't want to be too, let's say, too much hung up on that one system. It is perfectly possible that there will be various credit systems in a Bitcoin standard being developed, like the one you just mentioned, the one which BitCredit Protocol develops, and others. So they will be in free competition, and so to say, if you're a free market person, freedom to choose currency is another word for credit money, that is absolutely essential so that the best mousetrap will win. Now, actually, then it's the question, which is the best mousetrap? And that really depends on how you construct the credit money which you propose to the free market to adopt. And one of the things which is a beauty on the notes-based system is we have several hundred years of experience with so-called discount houses. They emerged in London around the 1700s, and within the shortest time, they had, let's say, activated an enormous amount of capital, like little amounts of money, which were stuck all over in the little provinces of England, which people didn't do anything, which was lying under the mattress, huddled, and it was sent then to discount houses in London, which could lend it out to businesses, and businesses got this money because it was a rather safe, well, pretty safe instrument, at much lower interest rates than was possible without those guarantee chains. So London, England, had an enormous advantage in world trade. They had about 10, 20 times the liquid capital which Germany, for instance, had. In those 200 years, Britain became the Commonwealth, the largest power in the world. So once you have a system which uses these guarantee mechanisms to reduce risk, you get lower interest rates. So that's one element how such a system can compete, the guarantee chain. And the second one, which is important, what the discount houses did is they handed out banknotes, fungible banknotes. In so to say, in the Bitcoin world, we can make a different use again of Xiaomi and eCash, which means that whenever a modern discount house, we don't need to discount anymore, this just needs to be minted, hands out Xiaomi and eCash tokens, over the whole lifetime of a bill of exchange when this credit is running, this Xiaomi and eCash can circulate with perfect privacy, which means we get automatically, with the existence of a private credit system, a mixer. No coin joins needed anymore, because what's written on the main blockchain in the end is the balance of thousands, millions possible transactions which happened in between. So you get perfect privacy, which, so to say, the cypherpunkish side of me really likes.
Well, a small terminological objection would be that when money is under the mattress, it's not doing nothing. You are still using money when you're hodling. Hodling just means transferring money to the future self. So it's still an active use. I think that we are using Bitcoin when we are not spending it every second, just as a store of value with another function. But below this very small terminological objection, my counterpoint would be that on one side, it seems like you are using an argument by a Lindy effect, like let's not reinvent the wheel from scratch, let's use what established and running for many centuries, we have experience there. But at the same time, our conversation started from the fact that this system eventually collapsed under the attack of the nation state centralization. So it seems like for example, the main difference that I see between a system of local credit between peers and a system with a mint is that the mint will have economies of scale. So it will have efficiencies. So it will attract a lot of credit, and then when it will collapse, we will not collapse locally, like me with Eric, oh, okay, you are not giving me back my Satoshis, I will be angry at you, but nothing systemically happens. When you centralize credit inside one single entity, when something bad eventually happens, and over a long enough time it will, then that's a perfect excuse for something like a state bailout or state nationalization to step in. So a big cashew mint, while it's very good for privacy and also very good for scalability, is very bad for the fact that the risk is not local but it becomes systemic.
Yeah, and this is the crux of the issue that we're dealing with right now in protocols is how are we going to structure these systems to get the efficiencies that we want as well as not create some sort of systemic centralized attack vector. And in this idea of localized credit, there's efficiencies to be gained, like the division of labor, specialization in credit allocation. These are valuable things that create wealth within the economy, but there's a trade-off to where political capture can occur at some particular level. It's like it's an abstract thing that we don't totally understand, but we want to look at what's fundamentally incentivizing trust to remain localized, and that's that trust doesn't scale well. As long as credit relationships aren't being incentivized through like central banking and forcing that to just be this pervasive issue where even if you go bankrupt, there's free money coming into the system and you're good. If when banks fail, they fail. Ultimately, I think that even with a minted system, it's possible that we could have enough localized type mint-based systems to where it might scale enough to create some efficiencies, but not too much to a systemic point of risk within the system. I don't have an answer to that, but I'm open to the idea.
Yeah, I mean, it is absolutely correct. If such a system is successful, any of the future possible credit systems, there will be economies of scale. It will centralize, like Bitcoin centralized. I mean, we know how many miners today are around which have a significant volume, so that will happen. But the mints are on an open source software. Anybody can download it. You can operate them essentially from any country in the world. I mean, the world is flat today. And so let's think back on what happened when China banned the mining, when mining was pretty much in Chinese hands, which was crazy by these guys, but anyway. What happened? The miners packed up their gear, they went over to other countries and resumed. And today the hash rate is up again. So I think as we build these things, we must make sure that we implement the same principles as led the principles of Bitcoin itself to reduce the attack vector by the government, by evil governments. I mean, good governments will probably invite that, like El Salvador, but to reduce the attack vector for bad governments by making it possible to transfer the mints out of the country essentially as soon as something becomes known.
I think we're out of time. I think it was very interesting. For me, it was very interesting. I just want to clarify that while I may be against credit in general, I have nothing against people borrowing me personally any Satoshi. So I'm always available. Thank you, guys.
Thanks, guys.
Thank you.